My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
Hey gang, welcome back. Today, zooming in from Orange County, California, we have a very accomplished real estate entrepreneur, Morgan Keim. And Morgan focuses a lot on contrarian markets. So a lot of people went through an absolute bloodbath in multifamily in the last few years. Morgan and his investors largely came out of that unscathed thanks to the contrarian way they look at doing deals. So Morgan, welcome to the show. Great to have you.
Hey, great to be here, Dave. And I love that about where you can go as a contrarian investor when you just look kind of the other direction sometimes. It's a fun topic to sort of unpack on these types of shows.
Awesome. So Morgan, first things first, give us a little snapshot of what you invest in, what kind of asset classes you guys like, and what the portfolio currently consists of.
Sure. So Ocean Ridge Capital is focused on basically building durable income, mainly for founders and high-income executives in workforce housing, multifamily properties. We look at mobile home parks as well. And then we're dabbling more and more into the world of alternative assets and private credit, sort of the future iteration. But we have a right to win, I would say, in the affordable housing space. And this is one of these things that it's not all that sexy. It's kind of overlooked on the national radar, but it's super recession resilient. And so a lot of the thesis of what I carry into how we evaluate opportunities is, how do we protect capital above all costs before we then start to, increase income to our investors, increase the return potential, that sort of thing.
So workforce housing, what does that mean to you guys? What does that actually look like? Paint me a picture of some of the properties that you guys have.
Yeah, well, it's actually evolving, Dave, and it's a good time to be having the conversation. But this started for me as a direct operator of what I would say are Class C multifamily buildings, which is affordable multifamily. That's not the nice luxury high rises. That's not even necessarily the workforce housing area where the trades people tend to live. It tends to be on the lower income side of things. Some of those properties have been actually government sponsored, and we've done a lot of work with the Section 8 programs and different groups like that. Now, my thesis here is evolving a little bit. Okay. And our, part of being a contrarian investor is being focused on not just kind of being where the ball was, but looking at where it's going and trying to lead it there. We're in an age of AI. Things are rapidly changing. And particularly it's my belief that the areas that are going to get sort of disproportionately impacted are going to be white collar jobs in tech concentrated cities. And they're going to be government sponsored areas because actually you tend to need the white collar folks to pay taxes to help the government sponsorship. So it sort of erodes a little bit of the long-term thesis of where that is for me personally.
And what does that actually mean? What do you mean by that? What's the scenario you're kind of envisioning happening, Morgan?
So what we're kind of watching happen in the last 3 months, there were 45,000 jobs lost from AI. They're mostly tech jobs. The average salary
just in the States.
In the States, the average salary was $185,000 per employee. That's
of those ones that got lost.
Yeah.
Wow.
And it's heavily concentrated, right? Because of where AI is going. I don't think this effect is going away. I think this intensifies. And where we're kind of looking at what's happening in the future is, where is this going to take more and more share away from workforce? What does that do to the people that maybe they were making 180 and now there's no longer that job pool for their type of jobs and they have to go make 130 as an AI implementation specialist or something else, right? They're going to go down a level in housing. They're going to go from maybe owning their home to renting, or they're going to go from their Class A luxury apartment into something that's a little bit more tenable at their new income range. That's Class B. That's workforce housing. And you juxtapose that with what we've seen in the last 5 years is this historic building wave of new multifamily supply that's come online primarily in these Sun Belt markets, but kind of all over, where In markets that are oversupplied and that have heavy tech concentration, it's going to be a double whammy. But in markets that are supply constrained, which a lot of those have been in the Midwest, a lot of them have been in the Northeast, and those that have diversified economies are going to see what I believe is going to be an amazing transfer of housing demand into the workforce housing Class B multifamily space. So where we sit today is we're kind of evolving our thesis from having owned a lot of Class C affordable government-sponsored stuff into a little more of a Class B type of market where we think this is actually going to have major demand tailwinds.
Interesting. So all those Class A buildings that these high-paid, now unemployed people were living in, won't those become Class B rental rates if the demand just tanks? Nobody's got a crystal ball, but I mean,
right. It's a good question. Part of it is, can they even offer that, right? Can a $2,500 a month apartment compete with one that's $1,500 a month? And maybe that's, the 1,500 is the Class B, right? But I think structurally, there's going to be somewhat of a rebalancing. And that's not just in the asset class, by the way, it's also in the markets, right? High cost of living places tend to equalize out. So a big part of our thesis, it's not fair to say, here's where we are, where we have been, where we are versus like where we're going. I believe that in the real estate space, for those savvy enough that are willing to kind of look objectively, today is the story of supply constraint versus oversupply and trying to go to those more constrained markets, and then economic and climate resilience. But they're not factors that are underwritten so much today.
Okay, so what markets do you see things going into? What's your contrarian take on things?
Gosh, I look at a lot of sort of second tier and tertiary Midwest markets, and we evaluate opportunities across a realm of things from, like I said, job and climate related things to landlord friendliness to population growth. I'm looking at all sorts of different trends like that. In terms of actual markets that we're investing in, I really like high concentration, of trades, and sort of Class B workforce. Oklahoma City is a fantastic market for that. You see, we have a pretty big position on 3 mobile home parks in Clarksville, Tennessee, which is an area north of Nashville. And I just like looking at the developments, especially when you see like American nearshoring places like Indianapolis, Columbus, stuff like that. Those are very compelling, and they're not ludicrously oversupplied compared to, some of the higher demand places where then building kind of overshot and there's this catch-up effect right now. So we're actively evaluating those kinds of deals, and especially where we can buy at a really significant discount to replacement cost. And that's a really key metric for me. I'm such a value investor, but I'm always looking, how can we get this 30 to 50+% off what it would be to build it new today? I think that's real, resilience, as long as the building's not completely screwed up and has other issues.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
So a few years ago, you were kind of looking at the crystal ball, and when everybody was zigging, you were zagging. Tell us a little bit about that story.
Yeah, that's a great question, Dave. So back when I started my original affordable housing fund, it was 2020. COVID had just rolled around. Everybody's grounded. And I was thinking, ultimately, I want to build a cash flow bridge for me and my family and, for the investors that I serve. And so this was right at the start of like a lot of the Sun Belt migration driven by COVID and policy and that kind of thing. And what we ended up doing is saying, you know what, we're going very counter trend. Let's go where we can buy some of the cheapest properties in the world, but where there's still high rents. And we identified Cleveland, Ohio. We looked at a lot of markets, by the way, from St. Louis to Birmingham to Memphis, a lot of class, C to D kind of emerging, developing kind of places that see some economic challenges. But we said, ultimately, what if we go in and create a bunch of new supply for the government subsidized programs there? Because the governments will pay rent for low-income tenants. And in a place like Cleveland, there's a 5 times backlog of the amount of people that need this kind of housing versus the amount of housing that actually exists.
Oh, wow.
So for us, we were able to identify there's a dislocation even in what they were willing to pay, which was about 30 to 40% above market rent. Nobody was looking at that in 2020. They were all going down to Austin and Nashville and building properties. And so for us, we bought in basically a single fund structure, all cash, bunch of small multifamily properties, then went and got a loan after fixing them up, recycled that, then went and got and just kind of made this little washing machine of value add and accumulated a portfolio of 20 multifamily properties in that fund.
Nice. How many units altogether in Cleveland?
So we had about 100. So these are small, kind of smaller multifamily.
Yeah, because again, we got to remember what's available there are a lot of properties that have been converted into multifamily. I'm sure 100-plus-year-old type buildings and whatnot. Yeah,
exactly. I think our newest property was like 1925. What the first one we ever walk into has an ice box in the front of the duplex, right? So it's amazing to see. But what we ended up doing is, having this cash flow vehicle that just kicked out consistently to investors every single quarter. And we were actually able to have a couple transactions that sold the entire portfolio. We said it was going to be a 10-year lockup on the fund, go through 2030. And what ended up happening is the world woke up to cash flow. And the least sexy market became the most sexy. And I mean, we saw like close to 20% rent increase in 1 year and decided, you know what? We're in such a great opportunity to sell this for a really good a really good price. Everybody's going to do great on this transaction. Why are we holding when we know we can get this today? And so that was a very recent sale.
Very good. Congratulations.
Thank you.
All right. So you're looking to kind of replicate that potentially. You're also looking at mobile home parks. What does the portfolio currently consist of, Morgan? Or are you kind of in flux after selling off that big chunk of properties there?
Yeah. So what I didn't actually mention is a lot of the work that I've done in the real estate space is built on me as an LP in over 50 deals in the last 12 years. So I've done, a lot of value add multifamily investing myself. Where this is relevant here is what I ultimately decided after selling that fund is my conduit at this point, the best service I can provide to my investors is basically diligencing a realm of different operators and their deal flow. So my focus at this point is basically acting as an institutional capital partner on behalf of different investors and different operators where we're diligencing the deals, underwriting everything, and bringing, kind of the top tier of what we can find to our investor base. We'll write, a much larger check, a few $1 million plus into that deal, and we'll get better economics for the investors that invest with us. Because essentially we're treated like a pseudo institutional partner.
Right.
And so that's the model today is we really focus on tracking a whole bunch of operators that we trust, diligencing well, and then, making high conviction bets on contrarian plays that I don't think people have woken up to yet.
Nice. Now you're mentioning a few other asset classes outside of real estate that you're looking at. Tell me a little bit about those.
Yeah, I mean, I do quite a bit of investing myself, as mentioned, and alternatives are kind of the key area in here. We're in the process of evaluating private credit right now, and we'll be planning.
What does that actually mean, private credit?
So, in private credit, I'm talking about the gap between where the traditional lenders may come in and let's say back a property or back a company, versus, sort of innovative approaches to providing financing. We're evaluating a number of different bridge loan providers in this capacity, where we're saying, if you're, let's say, a multifamily operator that's going to buy a distressed property and that you need a loan for a year or 2 years to make that thing right, and then you're going to eventually go get permanent financing on it from one of the agencies, you kind of have to go most likely to a private credit provider.
Right.
And your loan, it's not going to be 6%, it's probably going to be 12% or 11% for that. Well, those private credit providers are pooling capital together. And this can be a really consistent source of strong yield for investors. So we're really interested in really high kind of cash flow types of things that also have good downside protection. At the end of the day, if you're finding a private credit provider that isn't using a lot of leverage, that is focused on maybe keeping that loan on their books, a lot of these people tend to resell them, but if they're focused on underwriting really, really well, and they're getting loans that are maybe 2/3 of the value of the building, you're generally pretty well insulated against downside calamity, which again is our first criteria, right? But then maybe you can see 8, 9, 10% yield on top of that once everything's kind of protected. So those are the filters that we're kind of leveraging in to evaluate who our best partner is, where we can then ultimately offer extension to that fund.
Very cool. Very interesting. So that's on the plate for the upcoming 12 to 18 months. Anything else? Any other exciting projects you got your eyes on coming up?
I'll shoot myself in the foot for saying it because we don't have a vehicle here to play it yet. And I know we're talking a lot of sort of future and where things are going. It's just that things are shifting so radically right now.
Quickly too.
So quickly, right? But we're looking at some things in the data center and infrastructure area as well. And I mean, if you're watching what's happening in AI and the insatiable demand for power, there are opportunities. The need for liquid cooling, there are opportunities. The need for electricity, there are opportunities. The need for land, the need for water. I mean, all of these are just theses in themselves. And if you can find the critical pain point, the critical bottleneck within any one of those areas, there's billions to be made if you can find the right vehicle. So I'm not going to say what that is yet, maybe a future podcast, but in the niches of the riches, right?
Exactly. Well, fantastic. Morgan, thanks so much for coming on the show. And I'm sure there's going to be some folks interested in connecting with you after this. What's the best way for them to do that?
Yeah, absolutely. So you can look us up, oceanridgecap.com, that's CAP.com. We also put out a quiz, like a 2-minute sort of tell you about yourself, what you might like to invest in. And we have all different profiles based on your responses. So you should check that out. Just oceanridgecap.com/quiz. I hope you guys take it because it can definitely be helpful to make sure you're optimizing for the right things.
Awesome. Morgan, thanks for being on the show.
Thank you, Dave. Appreciate you having me.
All right, everybody, take care. We'll see you on the next one.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.